Good morning, and thank you for joining us for Vickery Holman's latest webinar. For those of you who I haven't met, my name is Clare Cochrane, and today I will be joined by two of my colleagues, Amy Durkin, who specialises in and heads up the lease advisory team, and senior valuer Kate Robertson. Together, we shall be demonstrating the merits of adopting a holistic approach to commercial property ownership by highlighting what factors can impact on the desirability and pricing of a commercial property investment. At Vickery Holman, we've got a multidisciplinary team, which enables us to provide our clients with expert advice throughout the property ownership cycle. Today, we're going to be drawing on our investment, lease advisory, and valuation service streams to cover the following topics. To start, I will highlight some of the factors we initially look at when acquiring an investment property for a client. Amy will then focus on the rent review and lease renewal mechanisms in leases, and lastly, Kate will explain the valuation process in more depth. Please feel free to submit any questions you have in the question mark box. We'll respond to as many as we can today at the end of the seminar, or if not, afterwards. So we're going to be using a case study today of a multi-let industrial estate. As you can see, it's a relatively standard specification with a mix of tenants. If we were asked to acquire this estate for a client, we'd firstly look and review the key headline figures and an investment summary. The purpose of this is to give us a snapshot of the current financial situation and the potential for growth. So what information does that include? Well, the WALT, the weighted average unexpired lease term. This gives us a high-level indication of the average time remaining on all leases within the asset, relative to the rental income from each tenant. On this estate, you can see it's 6.25 years, which is generally what we expect. A longer WALT is generally more desirable because it can be indicative of greater cash flow stability and lower tenant turnover. Monitoring this figure and extending lease durations can therefore enhance the asset's appeal to potential investors and impact value. A similar metric to this is the weighted average unexpired lease term to the break, and it's calculated in a similar way. The asking price, well, that's fairly self-explanatory, but our job is to undertake due diligence to form an opinion whether we think the asking price is in line with the market. We'd look at the capital rate per square foot overall, which is the asking price divided by the overall square foot, and this gives a rate per square foot of £82 in this estate. It just gives a broad level indication of the vacant possession values and how we'd look at that as well. Look at the total rent and the average rent per square foot overall. Does this feel low to us? Do we think there's a prospect of rental growth at a high level? We then look at the yields. The net initial yield, which is the current income net of costs, expressed as a percentage return of the capital value after adding notional purchase costs. And the reversion yield. This is the anticipated yield to which the yield will rise or fall once the rent reaches the estimated rental value. It helps highlight potential asset management opportunities and the potential for growth in income. There are now lots of really handy free online yield calculators such as propyield.com, and they're well worth having a look at. So once we've looked at these headline statistics, we just start to drill down into the finer detail with the objective of ascertaining what factors can impact these figures, either positively or negatively. And we consider the broader context and risks and opportunity for enhancing income and capital value of the asset. We'd start by looking at the physical characteristics, the location and the access, the size and type of the units. Are they commensurate with market demand? And is there a good mix? Because that can add to diversification, can add less risk. We look at the car parking and the circulation space and also the condition. We'd usually recommend a full building survey is undertaken, as this can highlight some future expenditure and any risks to income stream. And we look at asset management opportunities. Is there potential for improvement? Could there be higher value alternative uses that the units could be put? Essentially, can we add value? We then look at detail at the leases and the tenancy schedule. What's the tenant mix like? It's important to assess this because the quality and stability of the tenants are considerations in assessing the risk of vacancies and tenant turnover. Obviously, any tenant can go under, big or small, but we look at the size and the age of the business, the length they've been on the estate, their accounts, the industry sector, and whether there are any arrears and a credit rating. It can all just let us build up a picture. In the example of this estate, there's a mix of local and national covenants, which is some diversification. We look at the leases and anything that can affect income to the investor, such as the lease length. We've noted earlier how that can affect the WALT, and break clauses and lease expiries. From a diversification and risk management perspective, it's usually desirable to avoid having a concentration of lease dates on a common date. This is to help mitigate income interruption risk. There are some exceptions to this, however. We'd also look at the repairing obligations in lease. Ideally, we want everything to be FRI, where tenants are responsible for rent, maintenance, and insurance, ideally maximising the net income to the landlord. We'd again look at the service charge provisions, and again, everything in an ideal world should be recoverable from the tenants. We'd look at the security of tenure. This impacts the ability of us to gain vacant possession for asset management purposes and alter the lease terms upon renewal. And finally, we'd look at the rent reviews. What's their pattern and structure, such as upward only, any index link, or are there any index linked structures? And then when buying or selling a commercial property, it's really common to be asked for these things. FRAs, fire risk assessments, electrical and gas certification, asbestos registers, and EPC ratings, which are increasingly scrutinised. We always recommend now that clients investigate the cost of enhancement works to bring these up to a B or C rating. These might seem like box ticking exercises, and the majority of which on an estate like this are usually tenant responsibilities, with the exception of an EPC. However, if you haven't got them, uncertainty is there, and this is often perceived as risky by investors. We then do an in-depth analysis of the market. We need to understand the local dynamics, the supply, the demand of similar units, the rental levels, and what would happen if they were to become vacant. Could we re-let them? The economic trends and demand and pricing for similar assets, all considerations. And essentially, what is the current rent like in relation to the market? Is there scope for rental growth? And if there is, how and when can we realise that increase in rent? Rent reviews, lease renewals, and new lettings offer opportunities for increases. So it's important to understand these mechanisms in the leases. This is an area that Amy specialises in. So I'll hand you over to her for a more in-depth look at this.
Thanks, Claire. I work in the lease advisory team, who primarily work on rent reviews, lease renewals, and other lease inquiries. So I'll start today on market rents. This is the basics of the work that we do, and the definition up there is the RICS Red Book definition of market rent. Of course, in the real world, there are some situations that would differ from these stringent set of circumstances set in the definition, such as there may be related parties involved with a letting, or perhaps odd lease terms would have been agreed, which might have suited the original parties, but might not be expected in the market. And this is why we as surveyors need to take an all-over approach to looking at the rental value. The most accurate way to assess the market rent is to have regard to comparable evidence, and this will be recent transactions of similar properties. From this information, you then make adjustments to the rental level based on factors that affect the value, such as the floor area, the condition, location, and the other lease terms agreed. And you might hear surveyors talk about quantum quite a lot, and this refers to the concept of the larger the property, the smaller the rent per square foot on the whole. So looking at our case study estate, the smaller units would be let at a rate per square foot of, say, £10, compared to the large properties, which might be closer to 650. So where leases are concerned, there are specific times where the rent and the other lease terms can be altered. And this would be primarily in a new letting, but also in a rent review and a lease renewal. Looking at that rent review then, it's an opportunity to assess the passing rent of the property and potentially change it depending on the circumstances. And there are a few key points to consider with a rent review. Typically, the first thing to establish is how the rent is calculated. There are usually two options, either an open market or an index-linked rent, as Claire said. The latter is fairly straightforward to work out and involves looking up the appropriate RPI and CPI figures, applying these to the lease start date and the review date to give us a new rent. Until recently, the index-linked rent reviews tended to produce lower rent than the market rents. However, these figures have increased a fair bit in the last few years, so it's probably less advantageous now for a tenant to have this kind of rent review. A lot of these types of reviews have a cap and a collar, which is an upward and downward restriction to compress the range of potential rents that an RPI rent review will produce, make it a little bit more predictable for parties. For market rent reviews, the principles referred to on the last slide still apply. So we're looking at a hypothetical term set in the lease and assessing comparable evidence to come up with an opinion of rental value. And this lease will tell you most of what you need to know about that rent review. So there'll be a number of assumptions and disregards to be followed when looking at the market rent. And these usually include an assumption that the property will be vacant and suitable for immediate occupation. The hypothetical term defined in the lease is very often 10 years duration or the unexpired residue of the term, which may only be a few years. So it's important to make sure that we have that information to hand. And there are usually disregards to be had for improvements, say, made by the tenant. This can also be another area of contention. If a mezzanine floor has been installed at some point, we have to work out who has installed that and whether that space can be rentalised. And rent-free periods that are normal in the market are to be disregarded, but rent-free is an incentive, generally not disregarded, as this essentially represents a reduction in the average rent over the term. Time is not usually of the essence for rent reviews, so there is often a chance for a new owner of a commercial property to bring the rental levels up to a market level. Currently, overall, industrial rents are pretty strong, so now would be a great time for the owner of this case study property to look at any historic rent reviews to bring and backdate all the market rents, or to trigger any current or upcoming rent reviews. If parties can't agree new rents at rent review, we have the option of third-party determination. And the lease, again, is usually key in stating what sort of determination. And there are two options, either an independent expert or an arbitrator. There are small differences between the two. And there's a fair cost to this process and a little bit of time. So most cases are negotiated between the parties. But if there is a large gap between the rents from the landlord and the tenant, or if the valuation approach differs a lot, then the third-party approach is the way forward to ultimately get a determination and get a new rent in place. Moving on to the lease renewal at the end of the term. This is the process where the landlord and the tenant agree on new lease terms. And the tenant has the option of leaving the premises at this point, and the landlord, depending on the security of tenure of that tenant, also has the power to remove a tenant. The security of tenure means that the lease was drawn up with the protection of the 1954 Landlord and Tenant Act. And in a nutshell, this means that at the end of the term, the tenant has automatic right to renew, save for some circumstances, some exceptions that the landlord can state as reasons for having the property back. So in the case of a protected tenancy or inside the Act tenancy, which is what the tenants at this estate will have, either a Section 25 or Section 26 notice must be served. Section 25 is landlord to tenant and Section 26 is tenant to landlord. And this will give between 12 and 6 months notice, bringing the tenancy to an end. And whilst the terms are likely to be negotiated between surveyors in a similar way to the rent review process, there is also the court system available to parties should there not be an agreement on new terms. The court and or professional arbitration on court terms can make sure that new rent and other lease terms that are yet to be negotiated are determined. But again, this process can be fairly drawn out and expensive, and so in most cases, the majority of terms can usually be agreed. Now, with outside the Act leases, they're a little different. They don't bring any security of tenure. The landlord can remove a tenant more easily, bring in an alternative occupier, or can negotiate substantially different lease terms to those that were in place if they wanted to. And although the onus is on the tenant to keep track of timings when their lease ends, the landlord should also be proactive in speaking to the tenant in advance of this date, if new lease terms are to be agreed, to avoid a tenant holding over on an outside the Act lease. Finally, a few other issues when looking at investments and how to maximise the offer of the tenancies. So with a lease surrender, it's not something that's traditionally would seem positive for a landlord investor. However, there are some instances where agreeing terms for a surrender would be a good move. Tenants might wish to surrender a property for a variety of reasons, sometimes upsizing or downsizing, perhaps relocation, and then we've got some less positive reasons such as financial troubles. The terms of any lease surrender will be negotiated between the parties, but the decision to allow the surrender and on what terms is ultimately the landlord's. So this thought can be put into the benefits of having a vacant unit for a period of time versus the risk of the rental market and the expenses incurred at the unit, which were previously paid by the tenant and now will have to be covered by the landlord. In a lot of cases, a premium will be paid by the tenant to the landlord, which allows them to exit the lease early. And this is usually a figure equivalent to a number of months' rent, depending on the reletting potential of the unit. If the investor already knows of potential occupiers that are keen to be at the estate, the possibility of getting a unit back might actually be welcome for them. It might also be an opportunity to improve the covenant of the occupier by reletting to a stronger outfit, as Clare has spoken about previously. And then on looking at flexible lease options, which are becoming more and more popular, including license agreements. So more than just outside the Act, it's not uncommon now for parties to agree a very short term, 18 months or so, or rolling break options with 3 months notice. The use of a license agreement instead of a lease for a short-term occupier, or for those occupiers who might need varying amounts of space within the year, can be positive for landlords, making sure that their property is occupied and used to its full potential. In a lot of situations, occupiers will expect to pay a higher rent in return for flexibility of this sort. So the landlord could potentially attract more income from wholly or partially adopting this strategy along the estate. What is important to remember, though, with a flexible approach is the active management of the occupiers to make sure that the documents are up to date and the quick marketing of any voids is undertaken so that there is minimise any loss of income. So that was me and all lease advisory matters on investment property. And I'll now hand you over to Kate to take you through valuation of industrial investment.
Thank you, Amy, and good morning, everyone. I will now discuss an overview of the process we undertake to complete an investment valuation. Why do we do investment valuations? Well, investment and valuations are utilised when a property generates an income from a letting as opposed to a trading income seen in businesses such as cafes, pubs and hotels. As Claire discussed earlier, investment valuations allow a potential investor purchaser to look at a property and ascertain what kind of return or yield they are likely to achieve based on current and achievable rents at the time. We are asked to provide investment valuations for secured lending purposes, but also for pensions, portfolios, trusts and probate. So what do we look at for and inspect? Much like Claire, on arrival at any property, we first look at the location, its surrounding aspect, and the neighbouring properties, their types and their usages. We then consider the property itself, noting its construction, use, condition, access and parking, along with any signs of deterioration or issues. After which we measure. Depending on the type of property, this dictates what measurement format we have to use. IPMS is used for residential and offices, and GIA or NIA for industrial and retail, for example. We look at all the accommodation and note toilet facilities, kitchens, any shared use areas, balconies, covered areas and loading bays separately. We also note mezzanines and confirm any tenant improvements. We take photographs of the site, internal condition, fit out and any defects, along with a note on any solar or insulation panels fitted. Once back at the office, we research the site further, looking at ownership and tenure, land size, land registry, rights of way and highways. We check planning history, current usage, rates, land use contamination, asbestos, flooding, invasive plants, conservation areas and listed building status. We also have to check for mining and radon. Then, importantly, as Claire also mentioned, we investigate the EPCs and MEES, noting current grading results and review the recommendations. Then lastly, we review the tenancies and leases in place and create a breakdown of these, identifying review dates, break clauses and end dates. What do we need to undertake the valuation? Unfortunately, the answer is paperwork. As Amy discussed, the most important items are the signed and dated copies of the leases for all units. Any rent reviews undertaken since the lease commenced and any agreed increases. Emails stating passing rent can be utilised, but we would expect to see this with signed paperwork to support. Also, we would need confirmation of any changes to tenants, names or terms, any break dates that have been enforced, any notices served, and finally, any outstanding works on the property by the tenant or landlord. Sometimes unsigned document versions of the leases are sent to us from borrowers, landlords and agents. And although these may be correct, we have no way of knowing that these were the agreed final versions and have not been altered in some way since. Although they provide an idea of standard terms, they cannot be relied upon, which is why PDF versions of the signed and dated leases are paramount in getting valuations right. Signed and dated copies of any leases for all units, any rent reviews undertaken since the lease and any agreed increases. Confirm passing rent for each unit and any check. I apologise, give me just 1 second. I'm sorry, something has gone wrong with my screen. I apologise. Let me just flick. Here we go. Let's try that again. Okay, let's move on. So how do we value? So we've been to site, we have a pile of photographs and notes, and we have researched the property and carried out due diligence and reviewed the leases. Now that we have all of this information, we can start to produce our valuation. To do this, we must first find market transactions of similar styles of properties in similar locations which have sold in the recent past. The RICS Red Book guidance dictates that valuations are evidence-based. However, we must be mindful of changing market conditions and sentiment when analysing the comparable evidence. Local agent information is a must for all valuations, Agents are seeing changes in the market as they happen on a day-by-day basis, whereas valuers tend to only see this evidence once sales complete, which could be 6 weeks or 6 months later. And therefore, the discussion with agents is so important. Conceptual and market opinion is utilised in valuations. However, if agents say informed us that the market has shifted with a 10% drop in values, but there is no transactional evidence to support this, we would be hard pressed to verify these figures. If there are ongoing sales with this evidence, we will include and analyse this in the evidence to confirm an all-risk yield. Once yields and comparables are confirmed, we would undertake an investment valuation with the all-risk yield in perpetuity for those at market rent. Whereas any units not at market rent would see a term and reversion with adjusted yields to reflect risk based on time to rent reviews, break or lease expiry, and then capitalised in perpetuity. In terms of the case study, one of the units is at market rent and would undergo a straightforward income to yield in perpetuity, with the remainder of the units undergoing separate terms and reversions, acknowledging their differing time periods to rent reviews or lease renewals. If we had found any to be over rented, we would undertake a hardcore and top slice, applying perpetuity to the hardcore and adjusted yield to the top slice until lease renewal or rent review, if not upward only. Once the valuation is completed, Vickery Holman undertake a 2-signature reporting process, whereby a second signature will review the valuation and discuss with the lead valuer. This may result in adjustments or further investigation. Once both valuers are happy to report, it is finalised and sent to the client. As you can see, the requirements for an investment agent, lease advisory specialist, or a valuer all revolve around very similar inputs, with the most important factor being correct and available information. Properties that have up-to-date rent reviews and renewed leases provide less risk and therefore should, although there are always exceptions, generally achieve better values, whether through the mitigation of risk, being more appealing to purchasers, or having a secured revenue income. We will now happily take questions and go through any that are already in the chat forum.
Thanks, Kate.